Today we are bringing one more webinar topic with one more subject matter expert. And in this webinar, we will examine while investing, what is that first question we see us when evaluating a startup, whether a strong and competent management or a skilled team. So this webinar will provide the answers to all our questions like, can ESOP be the magnet in this? What and how ESOP framework should be, and what's the maths behind that? Well, to answer all these questions, I welcome Mr. Jalasina. He is the head of business development, and he plays a versatile role of managing sales, business development, marketing, alliances, partnership, and products. Jalaj is a qualified chartered accountant, having more than 18 years of professional career, and he worked with technology giants companies like TCS, and has been working with ESOP Direct since more than 12 years now. Apart from his current role of business development, he has managed consulting assignments in the past for large enterprises. Apart from that, Jalaj is a very good sportsman and a voracious reader. He likes to talk about various topics on strategy, technology, policies, and compliances. So I request Jalaj to please take us through today's topic of webinar. Similarly, to all participants, in case of any questions, you can write us in the chat box and all your questions will be answered during our Q&A session. So over to you, Jalaj.
Yeah, thank you, Shashank. Just confirm that I am audible before I begin.
Yeah, you're very much audible. Yes.
Okay. Thank you so much. So, Shashank read out a sort of a CV of mine, but to actually describe myself, I think I would say that I am very passionate about this subject of employee stock options and equity incentives and compensation. And that is where in the last 12 years, I had the opportunity, along with working with ESOP Direct, working on many of these projects and interacting with founders, senior management, Ps and VCs. So I bring in, I'm trying to bring out my learning and experience into this session. As we know that, we are witnessing a phase where the investment climate is a bit on a damper side. There's a lot of cost-cutting exercises and pay cuts and layoffs, which we are envisaging or seeing in the startups, especially the late-stage ones. So all the more this topic becomes relevant for us to take a deep dive into it. What I have done here is I bifurcated my talk into three parts. The first part is about what a VC would look into a prospect from a diligence standpoint, and especially from a management team perspective. The second part is about how a founder should see to setting up a ESOP pool. So what are the factors which goes into setting that pool up? And the third part is the math, how that math works out. So this is the three parts to the presentation. And as far as the question answer is considered, we'd like to take as many questions as possible after I finish my talk in the Q&A. If there are questions which remains unanswered because of the paucity of time, we'll certainly do it offline. So let me just share. You can see my, Shashank, you can see my presentation, right? Yeah. Shashank, I hope my presentation is visible. Just give me a signal or a go ahead. Hello?
Well, I'm sorry, actually, I was on mute. Sorry, Jalaj, you are asking something. Yes, it is very much visible.
Yeah. Okay. So these are the three parts to the presentation here. And we'll see the first part where they will talk about, and we'll also, I'll try to explain, from a VC standpoint, what they look in a portfolio investment. So basically, there are four key aspects of any due diligence when a VC evaluates a prospect: management, market, product, and financials. So management, while we'll explain it in, or we'll see it in some more detail, I'll take up market, product, and financials in this slide. So from a market standpoint, the three things which are important is from a what is the size of the market, whether this market is big enough to produce outsized return, whether the market will absorb the product or the services which are contemplated by the company, how this market is going to evolve in future. So these are some of the dimensions as far as the market is considered. Coming to the competition, has the company or the management team, founders envisage who are going to be the current competitors or who are going to be the future competition in this field? So what is that sense about the competition also comes in the market due diligence. The competitive advantage explains that as a company, as a management, whether we have the necessary skills and expertise to do things better than the others. So these are the three parameters from the market standpoint. Moving to product, the product goes through diligence on product market fit, product differentiation, and the value proposition. Now, product market fit is a very good concept. It has both quantitative and qualitative parts to it. So as far as the quantitative aspects are considered, this will be more from a feature standpoint, that whether the features which the product has or will provide, whether this matches the market expectation. However, beyond that, there is one more element, which is the qualitative aspect, which is even more important than the features there. So it basically talks about the client feedback, which is received through engagement and also through their feedback. So whether the product incorporates it over a period of time is going to be the key for any startup at a stage or at a later stage where they will be seeking funding. So to measure a product market fit, I think a good measure would be if there is a lesser attrition from the client's portfolio. That could be a good reflection that the product market fit is that is achieved. And the last level there would be where the product itself starts to sell on its own. So this is again the important concept, but the VCs are going to look at it in more detail when they do the due diligence on the product side. Now, the differentiation and the value proposition, again, these are the elements. So on a product differentiation, what are the differentiations vis-a-vis this product would be seen differently from the market? Is it a different model? Is it are we looking at the full range of features in this product? Or are we looking at only certain feature, but those features have been developed in such a way that it outsmarts any other feature? So the product differentiation strategy is also something which will be taken into great consideration. From a value proposition standpoint, I think the value proposition from a product is the client, how he withholds that product, whether what will be the state when they use it, and if they are not using it, what they will be missing out. So there is an articulation of the value proposition, which if we are seeing that the clients are staying in the company, we are not seeing much of a churn over there. That is, which shows that the value proposition the product has. Now, moving to the financial side, at a very early stage, the VCs might not go into the details of the financials. Still, they will evaluate it from capital funding requirement and what is the total capital the business will need and at what stages. And from a cash flows and profitability, when the business will start generating it, there will be metrics to evaluate. Especially VCs use ROI, which as well as IRR for their own purposes. So they will use those matrices for evaluating the investments also. Along with that, gross margin, revenue, expansion of it will also be the consideration. The third point there is exit period. So how we are going to, as a business, how we are going to provide exits to a VC, and whether this will be an IPO or a merger or a strategic sale, and whether we have a sense of the target, buyer or their environment is going to be the task which the founders will have on their hand to explain to VCs. So these are the three, parts which will market product financials. I think there can be webinars because these topics are very deep, and if we start taking each and every point there, I mean, we'll not have time to finish the concept what we have decided to discuss today. So management is what we wanted to, focus on. If you look at the management standpoint, there are three important, consideration there. And management, again, this can be combination of founding team, advisors, employees, the early employees who joins in. So this will be relevant to company, how they decide their management, what are the constituents of the management. So from a expertise standpoint, the domain expertise, what domain expertise the founders bring in, the senior management brings in, from a business, from a acumen standpoint, from a product standpoint, from the subject which is underlying that product or tool which has been created. So the domain expertise play a great role. Relevant experience. So as far as the experience in that business is considered or in that domain is considered, the tenure of the employees, the founding team with that experience in that industry. And along with that, not only the industry experience, the experience they have spent together. So whether they have been working in organizations, the same organization, or were from the same colleges, or from a same background in terms of their professional qualifications. So that also will be a due diligence criteria. Individual responsibilities, whether the business is able to delegate responsibilities to the individuals, and whether these individuals are able to collaborate with these responsibilities. It shows the confidence level in that business, in the company, which the VCs are going to evaluate in their due diligence when it comes to the management team. Now, the question will arise that since we have seen management, market, product, financials, all these parameters are important for due diligence. However, if some studies have shown that, and this is the next part, where the VCs put management due diligence as the most important part of their due diligence. And this is from HBR, where they're saying that we asked VCs what contributed most to the success or failure of their portfolio companies, and the management was identified as the most important factor by far. So management due diligence is considered to be the most important, followed by product market fit and the product, especially at an early stage of the business. So let us now deep dive into what a VC looks in for a management team. Now, as far as the profile, the growth, I mean, in this chart, you can see how the strength will, or the team will grow from the early stage to the late stage. So the first stage, there is the seed stage, where the business prototype, the product prototype is prepared or contemplated. So idea is converted into a prototype now. The team basically comprises of the co-founders, and there will be certain people who will join in as employees. We are calling them founding team here. Along with them, there would be certain advisors or mentors, because many of them come from accelerators and incubators. So they will also be supporting the management initiatives. When the company moves to the second stage, which is the early stage, you will see that they will start employing people. They are the early employees. So along with the co-founder, founding team, advisors, there will be early employees who will form part of the team. Some of them will move to the management level also. At this stage, the commercial product is arrived at, and they will start having customers. Moving to the third stage, which is the growth stage. So here, the experienced people will start joining the company. The growth stage executives will get added. So basically, this is the mid level management. Executives will join in. People who will have 10, 12 years, 15 years experience just to scale up that growth. So this is the high growth period. As the company moves to late stage, we will find C-level suit, getting added. Along with there can be an opportunity for a professional CEO also coming in. So basically, the C positions will be filled in anticipation of an IPO, and a CEO might also be, appointed to oversee the growth for the next level. So the co-founders, at this stage may take a backseat, whereas the executive and the company will, involve more professional management. It is also possible that we'll have professional directors on the board. So along with the investor directors, there will be professional directors who will come in, which is in anticipation of an IPO and the managed growth in the post-IPO phase. So this is basically the stage of the companies as far as this is the team composition is considered. Now, if we see in summary as to what has been looked upon from the management team, the expectation from the management team is basically the four points which I have highlighted next. The long-term view regarding the directions of the companies. Now here one can ask that whether we are playing to win or we are playing to play. So business is an infinite game, and typically a long-term direction will help support survival aspect. So we are playing to play, and this helps the business to come out as a stronger, as more innovative, and long-term focused company. So from the management team, which can be a composition depending upon which stage which we are, and every company will define its management team according to the way they look at their suitability. So the long-term view, the long-term directions of the company is going to be something which is important also from the VC standpoint to look at when they are evaluating management team. Whether we have the technical skill set and the experience to create the product better. So this is basically the competitive advantage. Whether this team would be able to create something which is better than the others, especially for a compelling team. I think the experience and the specializations always help. The third point is about the business acumen. So, I mean, we can have a great product, but if we don't have a good business team, I mean, it will not be a successful venture. So, the business acumen to design, effective sales and a GTM strategy is something which is a composition of the management function. And whether we have a team which can think of its strategy, think of its execution, and actually execute it is also the management team expectation from a VC. From a working together complements the management team skills is the part of the management cohesion, which I touched upon in my previous slide. So if we are, as a management team, as functions, if we have been able to collaborate and also delegate tasks to each other, it shows the confidence in the other function and also the leaders, who are there. So whether this is there in the company, whether the team can easily collaborate, they are not working in silos, the functions are effectively coordinated. So that actually is something which the VCs will appreciate of. Now, going to the next slide, which is sort of completing my part one of the this session, is how ESOPs are preferred. So, as we are focusing on management team, and we want to ensure that as a business, my management team is rewarded, they are motivated, and they also look at KPIs based growth. So whether ESOPs can help in achieving that is the part of this slide. So ESOP aids in strengthening of the management team, no doubt about it. It is a proven strategic tool. It's a In a competitive environment. Actually, it helps you with a lesser cash component to make yourself competitive in the market where the talent is at a crunch. So it's a great way to attract talent in a competitive market. It makes compensation attractive. This is paid through equity, so the company will save on the cash outflow, especially the early stage, growth stage companies. They want to save cash over there. So if we look at this instrument, the employees' salaries can be, or benefits can be quite attractive, because this gives them a piece of the future value, which can be quite significant as compared to what they will earn as their annual components from the company. The third is retention of key team members. ESOPs can be structured as plans. These are not like yearly bonus where your performance is appraised and you are paid against that performance. Here, this can be structured as plans, which can have 4 years, 5 years, 6 years, as many years as we want, and they can be structured in vestings where the employees will be motivated to stay longer in the company if they have to make out the full value out of their ESOP plans or their grants. It encourages the sense of ownership. So employees or the management team, in this case, if we look at, they will not directly on the cap table, but from a ESOP's entitlement or ESOP grants, they will have this sense of ownership that their equity is committed. So this helps in the motivation. ESOPs links business value creation with personal wealth creation. So there are limited opportunities for individuals as employees to create wealth during their careers. ESOPs is actually those points where they can create wealth. Typically, an employee generates wealth at the time of the retirement, where they make their savings monetized along with their retirement funds. Whereas ESOPs can create similar or more value before their retirement, and this can be many points in time in their career. So it links organization value creation and personal wealth creation. So this is very important from an overall ecosystem standpoint, because many of these employees later become entrepreneurs where they promoted their own ventures because of the ESOP wealth they have created. It's a good thing to have from a environment standpoint. And again, I mean, VCs appreciates this very much. This can be used to influence performance and growth. So ESOPs, we have seen time-based vesting, but ESOPs can also be structured in a way where their vestings can be linked to different vestings conditions. This can be organization level conditions, or this can be individual conditions. This can be peer comparisons. So there are many ways of structuring the vesting conditions in ESOPs. So this can be aligned with the performance KPIs and the growth OKRs which the companies want to have, especially when a VC is in. So ESOPs can influence that as well. Now, we have seen that the management team will always comprise of a founder. So the question, one of these questions, it's a very common question which comes to me in many of my talks, is whether founders can be covered. So if it is a startup which is registered with DPIIT, you can cover founders up to 10 years of the incorporation of the company. So that is also possible. However, if it is not registered, then the founders cannot be covered under an ESOP program. Now, VCs will always have something to say on the ESOP plan of the company, because that is also relevant for them, because for their investment in the company. So typically, if you see the VC sense, this will be more towards programs which have select management coverage, programs which are focused towards CEOs and CXOs and senior leadership. They believe that the vesting condition should be performance based, and it should be linked to growth drivers which are defined in the business plans. Exercise price linked to fundraise valuation. So typically VCs are not in favor of granting of RSUs or for that matter discounted options. They want to tag it to the FMV or the price which has been recorded in the last fundraise. They are very keen on the data points. So what are the other companies doing typically at that stage, how much pool they have set aside, how many employees they have covered, what instruments they have used, what are their vesting criterias, what KPIs they are using. So they are very keen to know about the peers and the industry in which the business is operating, and accordingly wants to benchmark with it. Uh, Exercises are linked to liquidity events. These are unlisted companies. So exercise in a closely held environment is not something which we see in many of our experience with VC invested companies. So exercise are linked to a liquidity event. This can be an IPO or uh, change in control or any fund infusion which happens in the company at a later stage. Even if they have not stepped in or after they stepped in the company, they want the documentation to be precise and accurate. The employee communication to be, where the employees have been communicated of the plan, their entitlements, the terms and conditions. So these are some of the guidelines, or if you are talking to any VCs, you can expect some of these guidelines or suggestions which will come your way. So I have now completed the first part of my presentation. We'll move to the next part, which is the employee stock option pool. How a founder or the company should be creating it. What is the thought process? So just to recap here, what we have seen so far is the due diligence aspects of a VC in a prospect. So we have seen the management, market, product, and financials, which were the four main criteria, and what are the main things they will be considering in their due diligence in that. And the management evaluation is the priority. And if you are looking at the management priority, then what are the means and ways of retaining them? ESOPs there is a tool which can help you achieve this. Now moving to the next slide. So how do we set up an equity pool? So there are basically two approaches to it. One is from a top down approach, which is on your left hand side, and the other one is the bottom up approach. I'll explain it. So basically, equity pool, criteria, whether we should have 5%, 10%, 15%, 20%. I mean, this will be another dilemma which the companies, the founders, the management teams will have. So this slide will actually help you in the putting that thought process into some working, and then taking a informed decision. So I'll start with the top-down approach, which is when we look at the companies, uh, we have to define its attributes. So whether our venture, what type of a startup this is. So whether this is a technology startup, or this is a services startup, or this is to do with trading or any other models one can think of. Typically the startup which are technology oriented, they will be required to set up a higher pool, because the requirement in a tech startup will be more in terms of the skill set. And as we have seen, the product will need a product development at each stage will need technical expertise. So there, if the startup is of a technical nature, then the pool size requirement will be more. What is the founder's skill set? So whether founders come from technology background or business background, or they have already done most of the work before it comes to Series A. So depending upon founder's skill set and the work they have done, you will have implications on your pool. If the most of the work has been done, then you will need marketing team, sales team, field teams to promote it further, which means that the pool requirements will not be that high. However, if the work is still to be done, majority of it, then you will need a higher, pool requirement. What is our hiring plan or a hiring need? We have seen in the previous slide. I mean, as we go along from seed stage to late stage and IPO, your team composition will change. So, are we able to determine our hiring needs, because people are going to join at a later stage, and especially at a late stage when you will involve C-suite executives, uh, and maybe professional directors, then they will also be required to be compensated and have skin in the game. So what will be our pool requirement should also take that into account. Typically at a Series A level, I mean, you don't need to think about 5-6 years. It is relevant that if you can project your hiring needs for next 12 15 months period, that will be good enough to create reserve there. Now, what will be the model in terms of the team size? So whether this will be less in number or high in number will have an implication on the pool. So higher team size might require a higher pool creation. Talent pool. So basically the scarcity of the talent will determine the size of the pool here. So if in the area or the geography the talent is limited, we'll have to have more in the pool to make our compensation competitive as far as the others are considered. The last point here is the investor term sheet. So if there are any percentage which the investors want it as a part of their policy or their framework, then that will also have a bearing on the pool which we are going to set aside at that stage. From a bottoms up approach, we look at the company itself and its own dynamics to decide what will be the pool requirement. So the first thing there is the estimation on the valuation. So whether the company, what will be the valuations of the company, the projections of the company, let's say for the next 4-5 years, and can we decide upon a valuation what it will reach by the end of 5th year, 6th year, so getting a sense of the valuation of the company would also give us a sense about how much pool to set aside. So, I mean, if it is a 5 billion company in next 5 years, which will not, I mean, the 5% pool versus a company which is just $500 million company in the next 5 years, I mean, 5% pool cannot be same. So we have to take into account the future valuations. After that, defining the coverage here. So, basically we want to do select management program, key people program, or this will percolate down to, -1, -2, or this will have a broader coverage, basically 60 to 40% of the employee strength. I mean, that will have that will be an implication. Now, after that, the criticality assessment. So the employees who are selected, can be defined in some criticality scale where the benefit factors for each criticality level can be different. So a higher criticality employee will have a higher benefits from ESOP as compared to a lower or a low critical employee there. So assessing the criticality and defining the potential benefits at each criticality level. How we are going to make the grant. So whether the grant will be one time and then there will be no grants during the vesting period, or this is going to be more frequent like annual grants. So that can also be a criteria. And after that, we'll have to set up our strike price. So this is basically the model which the companies can work out. And basis that they can define their optional pool. So on one side, you have the industry best practices on the type of startup, founder skill set, what these companies have been doing. So that will be a guidance. And the other side, you look at your own structure, your own team size, your valuations, your you know your compensation, what will be attractive to an employee, and figure out the individual entitlement, which will sum up to the organization pool size, and they arrive at a informed decision which can take best of both the approaches. Now, once you have decided on the option pool, from that option pool you can decide upon the grants, There are basically 5 types of grant the companies can contemplate. The hiring grants are the ones which are issued at the time of onboarding of an employee. So basically, when we are negotiating and there's a competitive environment, I mean, hiring grants are typically issued, especially at senior management level. Retention grants are those grants where these are back-ended in terms of their vesting, or even bullet vesting at the end of vesting period. Performance grants are the ones where the vesting conditions are based on the KPIs and or the individual criteria, their assessment. Top-up grants are given at the time of later fundraisers, or if there are any milestones which the companies have achieved during this journey. And promotion grants. So when an employee is moving from one level to the next level, promotion grants are also sometimes used. So the object of this slide was to evoke you in terms of looking this requirement of setting up of a ESOP pool from a much wider perspective, considering both the industry approach, which is the top down, and also the bottom up approach, and accordingly derive a program where you can contemplate your grants and execute this strategy well. So this is the second part. I'll now move to the option pool math. So basically there's some learning which I want to share here. Many times when I've been doing webinars, and even the founders, they come to me, and most of these founders, they are from a tech background, and might not understand how these options pools, the percentages are kept. There are ideas, but I thought that in this webinar I should cover this in terms of an example, so that this helps in understanding how that computation works. There are many places, I mean, there are many books which have been written about it. So I've tried to make it as simple as possible, covering the core concepts. So this is the first example where there is no ESOP plan in the company. So in a pre-money situation, so there's no investors as such. There are two founders, and they own the equal equity stake in the company. So the company is envisaging an investment. The investment money is 25 lakhs, so 2.5 million. And the pre-money valuation was ascertained as 10 million. So this investment money was to give 20% stake to the investor who is going to come in. Now this 20% stake, so let us just see this example here. So from our table standpoint, we know what is the equity holding of the founders, how much they, as a number of shares, and as a percentage, how much shares they own. From a valuation standpoint, this would have been arrived at by some method. So that has given a value of 1 crore or 10 million. Then the investment stake is for 20%. So this 20% is post money. So once the investment will come in, the investor should have 20% stake in the business. So this is the meaning of, when I say 2.5 million for 20% stake. Now, if we do a math here, 10 million is the value of the company today, pre-money. So if we divide this by 20,000, we'll get price per share, which is 500 rupees per share. So as far as the founder's equity valuation is considered, this is 10 million. So the entire pre-money valuation is the founder equity valuation, which is 10 million. So if I receive a term sheet which says, this is what as an investor we are willing to invest this much in the company, 20% stake, and we did your due diligence and we arrived at this pre-money valuation of 10 million, your equity valuation is 10 million. This is what you are owning, right? Now, what will happen in the post-money scenario? The investor will come in with 20% stake. Your equity base will increase to that extent. So 20% stake is 5,000 of 25,000. So this is the number of equity will increase. The founders will dilute to 40%. Both the founders and investor will get added to the cap table at 20%. So what does it mean is post-money valuation is 10 plus 2.5, which is 12.5 million. Shares which will be issued to the founders is 5,000. So 2.5 million divided by 500. So now what we have done is, incrementally, we know that how many shares to be issued to the investors for that 20% stake. So this is arrived by dividing that 2.5 by the price per share, and this is there in the example. So pretty simple to comprehend. There should not be any challenge to understand this part. Now, the problem, or as far as the ESOPs are considered, since ESOPs may be issued as options, they are still not converted into equity, or they might not have been issued at all. So the problem arises from this fact. So now if we consider another example where the investor is considering 20%, it remains same as a criteria. But now they are saying that there should be 20% ESOP for key management considered in the pre-money. So here, if we add ESOP in pre-money, we will see that my expanded base is 25,000 and my founder's equity will dilute to 40%. This is equivalent dilution. So both of them dilute by 10% each, which is being taken up by ESOP. Now, if we do the valuation will remain as 10 million. This is the valuation pre-money of the company. The price per share will reduce to 400 per share because the base has expanded. The investment money remains same, 225 lakhs for 20% stake or 2.5 million for 20% stake. So that as a assumption continues to be the same. So what has happened here is the founders have diluted, and they have diluted to that same extent. This is a proportional dilution. But the price per share now is less than 500, which we have seen in our previous slide because of the entry of ESOP. So your founders, as a founder, your effective equity valuation is not 10 million, it has gone down to 8 million. The problem is this ESOP pool might not have been issued at all. However, it is, if in reality this is coming out from the founders themselves because their valuation is getting reduced to 8 million from 10 million when there was no ESOP in the company. So what will happen in the post-money situation? So in the post-money context, if you see, your expanded base will increase because now the investors are coming in. Since the price per share is less than 500, their number which are going to, the number of shares for investors are going to be higher as compared to when there was no ESOP pre-money, right? ESOP pool is at 16%. So the post-money valuation is 12.5, but the share issued to the investor is more than what it was issued when there was no ESOPs in the company. Now, this is happening because the ESOP pool is considered, pre-money, and we have to maintain that same 20% for the investors. So investors are actually, they are not diluting because of this ESOP pool creation. Okay. But in reality, now assume that this 5,000 is not issued at all. It is just a reserve. So in reality, if you see on the issued capital, which is 26,250, the total of the three items, the top. So your investors are not at 20%, they are at 24%. So with issuance of ESOP pool of 5,000, they will come down to 20%. Now here, actually they are at a higher, percentage holding in the company as far as the issued capital is considered. Okay, so with this, if we were to, look at the concept part of it, whether ESOP pool is considered, pre-money, or this will be considered, after the investors, come in, there's a realization. One, if it is considered pre-money, actually it is the founders who are going to dilute because investors are not taking, they are not part of the pre-money cap table and they will not be taking any dilution. Now, if we were just to assume for a matter that there is another round which is happening, so this post-money will become pre-money, and if there is a ESOP requirement in a pre-money, this investor will also dilute along with founders and the ESOP pool. So this cycle will keep on continuing as we go along. However, the other important part is, suppose this company were to be sold and there are no ESOPs out of that 5,000 which has been issued. So the holdings of the founders and the investors continues to be, especially the investor continue to be inflated, but that was not the intent. Okay. So coming to the key takeaways here from this session is, one is ESOPs are a critical tool for management retention, and we have seen that venture capitalists, private equities, they clearly advocate for it for their senior management. They are inclined for having ESOP programs. They are inclined for their management to have skin in the game. So that ways, companies who would have ESOP programs would be benefited in their diligence, due diligence by VCs when it comes to the first investment round or going forward in their later stage investment round. Another sense which we get from our studies is that by the time companies, the startups, are closing their Series A, I mean, most of them would have ESOPs in place for their senior management or the key management. Uh, Typically, it is not broad based as a general sense. It is limited to still senior and middle management and maybe one level below. But around 80%, 85% of the startups, they establish their program by the time they close their Series A. ESOPs can be used to balance cost cutting exercise. So, this is relevant to the current, times where we are seeing the tighter funding environment. So, if we'll certainly need good people to be there in the business. So, for them, one can think about compensating their pay cuts in terms of, ESOPs. We have done a, session on this. So that is also available on our website. You can take advantage of if you want to deep dive into that part. Uh, on creation of the option pool, founders and investors should be aligned. There has to be a complete transparency in that, because as I say, pre-money, post-money, where the ESOP will get added, what will happen, if the company is sold and there are unutilized pools. So those aspects of the pool should be discussed and documented as a part of the term sheet. Initial pool should not be very high at that C stage. So this is also where because all this dilution will go to the founder. So typically a hiring plan, as I said, when you are raising round and you receive a certain percentage which is higher than your expectation, then your hiring plan for next 12-15 months will actually help in the actually coming out with the percentage which is needed for setting that pool up. Uh, the other 2 points are from a again from a VC standpoint, that as we receive funding in at respective stages, we should be topping our ESOP funds also, because we have seen in our earlier graph that your teams will increase. So your requirement at a late stage with C levels or with professional CEOs will arise, even with the professional members on the board. There would be an expectation. So your ESOPs, which were established at early stage or at growth stage, might not be sufficient enough to cover such requirements. Now, this is the last key takeaway, but I think this is one of the most important takeaway here. Uh, where if there's a situation where a pool has been created and that pool actually was pre-money which diluted the founder or the investors at that stage, then in a situation where a company is sold or there's a liquidity event, I mean, then that pool should go back to the founders and those investors were from where this was diluted, uh, as because the issued capital percentage, if we were to just distribute according to that proportion, will not lead to the correct results. So these are the key takeaways which I just wanted to highlight here. Shashank, I have finished my talk and ready to take questions if you have any.
Yeah, so everybody, we are just open for the Q&A session. And in case anybody has any query, they can please write down in the chat box.
Shashank, are we sharing this slides with our participants?
Yeah, basically we are keeping these slides available for the downloading also on the slide share.
Okay.
At the same time, we have recorded session also, which will be available on our YouTube channel. So even in case, probably, after going through the recording and the resources, one can definitely raise the question, write it to us, and we'll be definitely getting in touch with them for answering the same. So, well, I have one question from Asha Krishnan. I'll just read it out for you, Jalaj. Are there broad benchmarks on equity pool size for various stages of funding and tech versus non-tech companies?
Yeah, so Asha, as far as if you look at the pool percentages, so at an early stage, these are around 10 to 15%, and we can consider this as a general for all the startups. The tech startups will have a slightly higher percentage, but as I said, one should also look at what will be the company estimates on the valuation and the coverage they are looking at, because we don't want to set aside a very large pool if we are covering less number of employees. So for that matter, to answer your question, 10 to 15% is what we look at. In the whether you want to increase some more percentages depending upon this is a tech startup or specific to your business considerations, you can look at increasing or moderating it.
Well, thanks, Jalaj. And I hope, Asha, this is what the answer to your question. In case anybody, please. Well, I guess there are no more questions around this. So, Jalaj, thank you. Thank you for such a valuable and a very informative session. And thank you for all the participants who have, joined. And as I mentioned, you can definitely get the recordings of the same and the downloadables also. So I'm just repeating, in case of any questions also in future, you can just write it to us and that will be answered. Thank you. Thank you very much for this. Wish you a good day.
Thank you. Thank you, Shashank. Thank you, everyone.